Um, and some of that was happening before the whole lockdown pandemic situation, but then obviously it went into overdrive in 2020. And one of the things I was doing at the time was pointing out that this was very different than some of the mechanics we were seeing back in the global financial crisis. This wasn't just, say, QE for like bank recapitalization. This was actually basically QE to monetize unusually large fiscal deficits that were actually getting out into the broader non-banking system economy. And so, kind of my view at the time was this has very different implications. And then as it continued, the implication was this was going to be inflationary for prices, not just money supply. Um, and so that's been a key part of my investment thesis. It made me bullish on a number of assets. I had big debates with kind of like the bond bulls at the time. They were saying, no, this is not real money printing. It's going to be disinflationary still. And so that was kind of my whole endeavor back then. And I started using the phrase "nothing stops this train" that they're gonna claiming that they're gonna get back on track. I mean, earlier this year and kind of late last year after the election, there was this big idea that Doge and Elon Musk are gonna get this back on track. And I was just looking at the math and saying it's almost impossible. There's very little that they're going to be able to tackle that will actually get this back on track. So one, demographics. Basically, for decades, the baby boomer generation, which is very big, was paying into the system, and now that they're effectively retired and increasingly retired as the years go on, as even the youngest baby boomers start to retire, they're now in big drawdown mode. And so over the next 10 years, the existing 3 trillion in the Social Security Trust, which is held by intra-government debt, it's kind of the wonky accounting that they do, but that's going to basically pour back into the economy and transfer to external debt. And that's spendable income that enters the broader circulating economy. Then there's the interest expense. But Japan, despite being on average 10 years older, has much lower healthcare costs per capita. They live longer. A lot of factors there. But the United States has, the other part of retirement spending besides Social Security is the whole Medicare spending and the broader healthcare industry. And so basically, for 10 plus years, basically any sort of investment horizon that anyone can plan around, the deficits are virtually unassailable. And then the punchline, which I didn't get to at the conference, but I've written to before because it's a somewhat of a longer topic, is that compared to many other developed countries, like let's say Germany or Canada or whatever, the United States' tax receipts are more closely tied to its stock market performance. That's partially due to the fact that we're a global kind of hub for equity capital, that the whole world wants to invest in our equities. It's partially because we have higher wealth concentration than many other developed countries, and it's partially because of our nuances of our tax code. And so as we look forward, let's say they do cut interest rates, which is certainly possible. If we have, for example, you know, pretty rapid gains in say AI, keeping white collar wages not growing very quickly, and kind of at a productivity boom from there, and kind of the way that they choose to measure CPI is not particularly going up very quickly, which gives them levers to kind of cut interest rates. That's certainly possible, but then it just goes back to, you still have the other component. You still have the Social Security component. You still have the Medicare component. You still have the defense component. You still have that whole complex. Interest rates are one of the key factors. But then it goes back to also the prior point of it's a trend change. So even if interest rates don't keep going up, or even if they don't stay at the level they are now, and the important thing is they're not falling anymore. Even if interest rates go back down to say 2% on the short end and 4% on the long end, or whatever the case may be, that's still not a liabilities or in their own currency. It's almost always the devaluation option, which and I consider that a default as well. Basically, if you massively devalue bondholders on a purchasing power basis, then that's a type of default. And basically, when you kind of we've gone through this cycle. We keep building up private sector debt. Then it gets so bad that they transfer a lot of it to the public sector. They kind of have this kind of rotation that happens. And when it's all in the public sector, there's really nowhere else for it to go other than default. And if you're an emerging market, you often default nominally because you literally just can't acquire the dollars that you pay back, much like a private corporation. Whereas if you're the United States government, you print the difference. And depending on the level of productivity, that will affect how much bondholders even realize that. Because, for example, during the 1950s, 60s period, bondholders weren't exactly complaining and yet they were underperforming basically anything else. So it's not like all new because right now existing currencies are partially backed by dollars, treasuries, and that sort of thing. And to the extent that you undermine that and give people dollars a little bit more directly, more pegged, it depletes that other one. Now it is pegged at a higher rate. So if for example, let's say a given developed market currency, so let's say 20% of the money supply is backed by treasuries by the central bank, and instead those marginal holders switch over to holding stable coins that are backed 80% by treasuries or whatever the case may be. That changes the ratio. And so basically what it does is it transfers seniorage from other central banks more to the US. So I view it less through the interest rate channels being effective because, like you said, I don't think that it's going to like materially, massively change interest rates. Yeah, around the margins, it can. That's not the big avenue. I think the biggest avenue is that right now there's all these marginally increase the demand for dollars, and then by extension treasuries, and just kind of it's mostly about that backing ratio shift to the extent that these are able to penetrate into those economies more than physical dollars. It's less. I view it less about the number of getting the number of dollars out there. It's partially it impairs in some ways the exchange rate between the dollar and other currencies, and kind of the thing that can happen is let's say you have this kind of country with an increasingly impaired currency. It's a developing country. It's got say 20% dollar backing for its currency. Early adopters that say previously had trouble getting into dollars due to border restrictions and other things and bank restrictions, to the extent that stablecoins allow them to get into dollars more than they previously could, earlier adopters that do that benefit because as people get out of that local currency and get into a more backed version of the dollar, the other ones potentially are the ones that are transferring purchasing power to the ones that got into stable coins earlier. Now, the same is true for Bitcoin. The same is true for any other scarce asset. And it just so happens that currently the biggest two ones, Bitcoin and stable coins, are, and then they have, yeah, so there's like a number of steps that people get through. I mean, that's partially why we both do what we do, is to kind of educate and share what we research along the way, to try to be part of this information trend. So as information gets more, easily out there, it still relies on people doing work, doing research, and sharing it with others, to say here's what's happening. Here's okay, here's arguments I'm seeing. Here's answers to those arguments. And over time, people get it. And another point that I made is like people can see one or two bubbles and dismiss them. So if they see kind of Bitcoin rise and collapse, like, oh, the bubble's dead, they don't necessarily go look at the log chart and see that there's been a couple bubbles. They only can really often know the bubbles that they saw. And the first really public bubble was 2017. Then there's the whole second bubble, but then people could be like, well, that was COVID, that was that was the money printing thing. So we got this kind of second aftershock, and people were able to dismiss that. But now it came up a third time. So this is the third quote unquote bubble that there. And like I invest partially in private markets too, and like there are companies that are just frozen in indecision because they might have a Chinese supply chain, and it's like, well, should we try to retool this and put it in the U.S. and ironically lower the quality because they're like, we can't even find U.S. manufacturers that make this the same way, so we'd have to like simplify the product in a negative way, and it's more expensive. And imagine we do all that, and then there's some sort of tariff change where the tariffs go away, and it's like our competitor that didn't do that and just kept their Chinese supply chain is ahead because they didn't spend money retooling everything. Or if we sit down and do nothing, what if these things don't change, and basically our margins are wiped away and we're kind of operating at a very high level? So there's a lot of companies that are just their default is run more conservatively because we don't know what things look like 6 months from now in terms of margins, in terms of our ability to make long-term contracts with our suppliers, counterpart equities, because they're the ones kind of swimming in these tariffs. So I view it as highly disruptive. One of the kind of the offsets to inflation over the past 30, 40 years, part of what fueled lower interest rates was globalization. And globalization is in some ways more fragile, but it's more productive. So as long as entities are not arguing with each other, that tends to be a pretty productive way of doing things. there are winners and losers from that, but on average, there are more winners than losers. And so this is like a trend change where I think we're entering a more protectionist environment. Even if some of this gets dialed back, I don't think it's going away entirely. And I think that certain kind of international relationships are persistently changed now because of some of these decisions. And that again, that's direction versus the other one. The classic example of like a king and then his advisors around him kind of pulling him in one way or another. And in this administration, there's the side that kind of laid this out the most articulately. If you were to see if there's an attempt at a master plan, they kind of spelled that ahead of time, which was like basically Stephen Myron, that's Trump's chair of the Council of Economic Advisors. He published an academic type of paper in November 2024, so after Trump was elected, and it kind of said if we were to reset global trade, how would we do it, and what are the risks associated with it doing it? So it wasn't like this kind of political piece. It was kind of this like more analysis type piece, and it was kind of the steel man version of what they're trying to do. And I think that the critique I would give of that paper, having read it, is that it kind of made too many generous assumptions about the U.S.'s leveraging, like position in terms of the leverage that they have in these negotiations. The view was, okay, we ramp up tariffs. That'll squeeze many of our trade partners. It'll strengthen graphics issue, their real estate bubble, and leverage that was attached to that. But then the other factors keep being either misunderstood or just ignored completely. Like one, they're by far the biggest electricity producer in the world, which is relevant for a lot of manufacturing and other types of energy production, like the raw heat needed to make heavy industry like steel. You can't just like magically teleport all that infrastructure to other countries or to the U.S. That takes many years to move, even if there are economic shifts that happen that incentivize the movement of that. So that's an incredibly valuable asset that they have, that industrial base, the energy plus the manufacturing capabilities. There's also human capital. So there are certain hubs that are good at things. Like say in Silicon Valley, you have the VC environment and the networks of funders they're fully ready to fund them. There's all this connective tissue there. Same thing in New York with investment finance. Parts of China have really strong manufacturing hubs. There are people that many other people in the world have to think about the dollar, whereas Americans don't have to think about their currency. We kind of have this bubble. When you travel outside of it, you see it more directly. So you see directly Chinese cars taking market share. So in addition to me as a macro analyst seeing this on a chart, I could actually go there and see what's happening on the ground. And it's going through a similar dynamic that South Korea went through, and like Hyundai, where they enter the market and they say, okay, we're not the best quality, but we're cheap and we're good enough now. And that matters for the lower end market that demands cars. In a lot of these countries, people still drive motorcycles and other smaller vehicles. And when a vehicle can come along and be $15,000 or whatever the case may be, and be pretty high quality, that's an entry point that people can get into the auto market for the first time, and it can compete there. And then when you get better at that market for 5 years or 10 years or more, you can move up the quality spectrum to the mid-level and then sometimes the high level. So Japanese automakers did it, South Korean automakers did it, and now Chinese automakers are pretty well along. And in terms of sheer numbers, they're already number one. And I think they can over time take more and more of the high end as well.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.